Greetings, everyone. My name is Sunil Sharma. I'm the Chief Investment Strategist at Ambit GPC, here with the monthly update for November 2025. So we'll start with India. So we've been making the case since March of this year that the macro environment was improving for India, and a number of things have happened over the course of the year that would lead to improving on-ground situation as we move towards the end of the year. And we're starting to see that. We're starting to see that in a recovery in agri credit. We're starting to see that in a pickup in commercial credit. We're starting to see an explosion really in credit to small and medium sized businesses, and also very strong data on medium industry growth as well, up 14% year over year. And we're also seeing very strong data coming out on passenger vehicle sales, on medium and light commercial vehicle sales, as well as tractor sales. So a number of these indicators is what we focus on this month. Now, the other way to think about this is looking at the GST collections, which have tapered off, and that's actually a positive because that's more money in the hands of consumers, and that money is being spent. Before we get to that, we are also seeing a continued strength in public capex, which is lumpy, but the 3-month moving average is growing steadily, and so public capex continues to come through. We're also seeing a strong pickup in industrial production, and we're seeing it particularly in electronics, electrical equipment, and machinery, as well as motor vehicles. Another reasonably good business cycle indicator is imports on non-oil imports, and those have continued to rise as well, and showing strong momentum in recent data. There are a number of other data points that we've shared in the commentary, and so I would urge you to take a look at those as well if you're interested. Moving on, the other very important macro factor is the gap that is now in place between the repo rate and CPI down to 0.25%. So we've got one of the largest spreads between CPI and repo in at least the last 13, 14 years. And so that opens the way towards further rate cuts should it be deemed necessary as we look at growth coming through for the quarter. And the other factor that should aid in terms of the recovery is systemic liquidity is now consistently on growing and on the positive side, and so that should also help the markets. And the final data point that I'm going to leave you with is earnings, and we'll focus on mid caps. Quite impressive earnings data coming through, 10.9% growth on the bottom line, year-over-year sales growth, and 22.2% earnings growth for the mid caps. And there's a lot more parsing and a lot more information in the commentary on large caps and mid caps, as well as our outlook on Indian markets in detail. So please do take a look at that if you're interested. Next, we look at what also is quite important is what's happening with the US. And this month we do delve into in detail into whether we are in a bubble, and we've shared a number of data points comparing the current environment with the environment in the late 90s. So we look at the Nasdaq bubble versus today, and our opinion is that we are clearly not in bubble territory as defined by some of the parameters that were in place in the Nasdaq bubble. Secondly, we look at NVIDIA earnings, and we find that there's some reason to be concerned, particularly about the circularity of investments, as well as the some of the accounting build up in accounts receivable, inventories, etc. Certainly raise questions about the AI story. And again, that does not take away the dominance of the US tech leadership stocks. And so that will remain in place. But there are certainly implications for what on earnings could transpire should the investments and the growth momentum in AI taper off. And so that's something that we're keeping a clear watch on, and something that could have implications as we move forward on the story around U.S. tech and dominance. And it largely is important in terms of the U.S. economic growth as well. The two drivers of U.S. economic growth have been one of the capex investments for AI, which is roughly driving close to almost 45%, 45% of GDP. And the second driver is the very strong performance of the tech Max 7 in particular over the last few years, which has led to a wealth effect that has benefited the top quartile of the market and driven spending. So both of those are key in terms of how things shape up for the US, as well as other factors that are related to the economy. And so we delve into that, and there's a lot more detail in the commentary on the asset allocation. So US equities, we have been overweight tech since February of this year, so sitting on very handsome gains on that. But we are watchful of what happens and how things transpire. There is a strong fervor for US equities, particularly large cap Max 7. So that will remain in place. And again, what comes forward as more data comes forward on AI is something that we're going to be watching. Secondly, we took some profits off the table on our silver tactical trade, remain overweight silver, and remain holding on to the remainder of our silver tactical position, and remain bullish on gold as well, overweight gold, tactically overweight silver, and waiting for the next leg to start as we get more data coming through. That's it from my side. Remain overweight equities as well, India, and that's it from my side. And thanks for watching. We'll see you next month.